Good morning. Today is Wednesday, March 30th, 2022. We will talk about what is on the screen presently. It's the Adp employment number that came out 15 minutes ago. But for now, we're going to actually start off with an update on the Russia-Ukraine issues. And yesterday, the market did rise rather robustly at one point, up 1.4%. We're giving a little bit of that back today. And the reason we're giving that back is that both sides have kind of come back, issued their statements and said that don't read too much into the meetings and whether or not they were constructive. You have the Ukraine presidential advisor saying that the war will still be in an active phase for a week. You have Russia that's pulling back from Kyiv and the northern city of Chernihiv, and they're saying that this is a de-escalatory move, but they also say that de-escalation does not mean a ceasefire or complete withdrawal of troops from around the capital. Other watchers are basically saying they need to solidify what they have in the east, in the Donbas, finish the job in Mariupol, and then they'll have that land bridge around the south from Crimea through Mariupol into the Donbas. That's their near-term strategic goal. Kirby, the U.S. general, he came out yesterday and said that he does not see any reason to think that Putin is backing down from his larger ambitions. Having said that, it now seems like the Russian goal is to have that land bridge from Crimea to the Donbas and then get that territory as well. This would result in a ceding of about 20% of Ukraine's internationally recognized territory. Meanwhile, the fighting does continue in Kyiv at a little bit lower tempo than it was. So that's positive. And even just the fact that Ukraine presidential advisor is saying that the war will still be in an active phase for a week, that's certainly an improvement from where we were a week or so ago. So I do think that we're moving in the right direction on the Russia-Ukraine situation. Having said that, obviously it wasn't going to be an overnight fix, and the market is pulling back a little bit. You have oil up, kind of that war trade is back on a little bit today. Moving on to the economic data. As you can see on the screen today, we had an Adp employment number. This is the number of new jobs that were created in the month according to Adp. This is on private payrolls, and that was up 455,000 in the month of March. Now, the Adp employment number has been way off the official numbers that end up coming out on the Friday. It's been way off for at least the last 3 or 4 months, and I don't really have a reason to think that would change this time around. This was a fairly decent number. It was basically in line with expectations, and it comes on the heels of the JOLTS job openings report that came out yesterday that said we have 11.27 million job openings in the United States, roughly in line with the 11.28 million from last month. What's interesting is where the job openings are. Job opening rates rose most for teachers. There's now 5.2% of positions that are unfilled, up from 4.6%. And in the arts and entertainment and recreation sectors, that's up to 8.5% openings for every job that needs to be filled. That's up from 7.3%. So 8.5 up from 7.3%. What's interesting here is that the quits and layoff rates have basically stabilized across all the sectors. I went sector by sector by sector. So what this is saying is that this is new demand. These are new job openings that are being issued. It's not a function of people quitting one job and joining another. This is a function of demand. And I think it makes sense. As services come back into the U.S. economy, you're going to start to see more demand around those types of jobs. And you're going to have to see hiring pick up in the service sector. And in fact, that's what we're actually seeing in this non-farm payroll, in this Adp report today. If you look line by line, you can see some decent job growth in the goods producing sectors, but really strong jobs growth in the service providing sectors, especially in leisure and hospitality and in education and health services. And I think that's where the job openings are, and that's where people need to focus hiring, because there's this anticipation of demand as well as just a shortage, just a significant increase in demand there in those spaces right now. Finally, and then I'll hand it over to Tom to talk a little bit about what Europe is doing. But in terms of the consumer confidence, you have a high degree of confidence about the present situation, about their present jobs, about their present incomes, about their present assets. That really came in strongly up to 153 from 143 in the index. But the consumer confidence on the outlook actually declined down to 76.6 from 80.8. There are a few reasons for a declining in confidence on the short-term outlook. People scared about rising gas prices, Ukraine war. And so the conventional thinking is that when you're really confident about the near term, about where you are right now, and you're less confident about the future, you might defer that purchase of a new car. You might defer that purchase of a house. And so you might put off some of those big ticket items. So we'll see what happens with that. But in terms of where the consumer is currently in the present situation, they actually feel really good about where they are. Big news yesterday in bond world was the yield curve inversion. Tom, you want to talk about that?
Yeah, so yesterday we saw what is traditionally seen as the basically a recession signal or recessionary signal, which is the 2-year Treasury and the 10-year Treasury briefly inverted. And we talked about that a lot. We talked about it a lot in 2019 internally before we had these calls, and when we did the macros, we talked about the potentialities of an inverted yield curve in 2019. And basically, the traditional view is that over the past 80 years or so, every time we've had a yield curve inversion, or at least most of the time we've had a recession following, somewhere between 7 and 24 months after that happens. So if you look back at the global financial crisis, we had the yield curve invert in 2005 and then again in 2006. And then the market basically overheated towards the end of 2007 with the housing market coming to a fever pitch, and then the market crashed. In terms of 2019, we had the curve inverted, and then we had COVID-19 shortly thereafter causing a recession. A lot of people are a little skeptical that one even counts. There's a lot of skepticism even when it happened that it was a function of the Fed artificially inverting the yield curve intentionally by hiking rates too aggressively. And so it's not a great sign in terms of the future. However, traditionally what happens is after the yield curve does invert, the market goes on to have quite a run. The period between 2005 and 2007 was pretty exceptional, as was the period between summer of 2019 and the pandemic beginning. And so the question is this for real? Is this a situation where the death toll has been rung for the economy, and we're going to hit a recession sometime in the next 7 to 24 months? And if so, what is the plan to move forward on that? And there's been a lot of discussion. We talked about it, for 4 hours yesterday afternoon, I think, after it happened. What does it look like? Is this real? So it's definitely something we have monitoring. But traditionally, if you start to short the market at the moment that the yield curve inverts, you're going to end up holding the bag for potentially a very long time. And so keeping our eye on the ball, understanding what's going on in the economy is going to be paramount going forward, because it's happened. The mark is on the wall, and now we got to figure out what we're going to do in terms of managing equities, managing bonds, in order to not end up getting crushed by a recession as it happens, and being a little bit more aware that it's a possibility now that has happened.
Yeah, and we chatted about it yesterday. I don't know how much I read into the data point. It's a relatively wide range. It's happened a relatively small number of times. I know it's a thing, but even the most recent time, were it not for COVID, which I do not think the yield curve inversion was predicting, I don't know that we would have been in a recession within that time frame that people expect. So I don't know. I'm a little skeptical. I recognize the trend and it's been there, but I think you're also spot on to realize the recession doesn't occur right then. Even if we do view this as somewhat predictive, we need to be disciplined to allocations. We need to be keeping capital at work. We need to be looking at other aspects of the economy. And then we're seeing pretty wild data on the housing side. Talk to us about what's going on there, and then we'll talk a little bit about what's going on over in Europe.
Yeah, I think on the housing side, the big thing is, I think that a lot of people are concerned about rates. right now, and understandably so. It really certainly negatively impacts affordability. Having said that, and you're probably going to begin to see data that suggests that the housing market is slowing. That is a supply issue. So I really like that. The national data is fine. It is what it is. But the best data is actually on Redfin. They update this weekly, and it's a national overview about housing transactions. And what we're seeing is that supply has really dried up. We're seeing fewer active listings, and this is resulting in slightly fewer homes sold this time this year than the same time last year, about 1% fewer homes sold. However, demand is actually through the roof. Prices have actually accelerated. They're now up 17.6% year over year. That's up from just 15.3% last month. 59.3% of homes are off the market in 2 weeks. You got 19 and a half median days on the market. That was 26 and a half days last month and 28.7 days this time last year. So houses are moving extremely quickly. The sale price to list ratio is 102%. So that's continuing to accelerate. So people paying significantly more than the list price. And so the bottom line here is that we're not seeing really price degradation in sales because home inventory is extremely tight, despite what the interest rate environment is. And so I actually think that this is a good news for the housing market. I think that higher mortgage rates do hurt demand at the margin, but because supply is so limited, we're not seeing that demand impact. The threshold for that was the binding constraint is supply. The binding constraint is not demand. And that's been the case for a while, and it continues to be the case today.
Thanks, Ben. Interesting comments from Christine Lagarde. On March 21st, she noted that we are not seeing elements of stagnation now, even in the bleakest scenario. And then right now is saying we will face in the short term higher inflation and slower growth. Households are becoming more pessimistic and could cut back on spending. I mean, this is a very stark change of assessment on the economy over there in Europe very, very quickly. Tom, how would you reconcile that? I mean, we talked about the Fed a couple of weeks ago, where y'all heard a former Fed member talk about, kind of fumbling around in the dark and seeing how far they can push the envelope before it pushes back. How is this that, or is this a real sign of change?
I think in our assessment, we talked about the initial comments last week when she made them, which was that it was a real head scratcher because the data was not supporting her assessment that, even in a bleak scenario, they were going to see 2.3% growth for the year. Because I believe at the time they had posted a 0.3% growth for Q1, which means they would have to massively outperform towards the back half of the year, which seemed extremely unlikely, especially given everything going on in Ukraine and their new hawkish tilt on, increasing interest rates in Europe and thus it effectively slowing the economy. So at the time, it was just very confusing. It didn't make any sense. And we were kind of like, man, this is a credibility problem for the ECB. Smash cut to 9 days later, I think we're getting a real signal, which is that, the reality is that they can't put it in the spin zone and say, hey, actually, everything's cool, guys. Nobody freak out. When in reality, everybody looks at the numbers and sees exactly what we see, which is that European growth is slowing. They're going to be in a tough spot. I mean, they're up against it with this war in Ukraine, all of the potential problems with the sanctions. It's just not a great scenario for Europe. And, they continue to just drop the ball. I mean, we talked about it with the Barclays issue with, getting sanctioned for issuing too many of these weird esoteric bonds. I mean, people are just, Europe is just a mess. It's been a mess. It's going to continue to be a mess. There was a lot of pushback on Brexit. I think Brexit was ultimately the best move the UK could make to disassociate themselves from the European Union because it's just a mess. And I think that this is a great example of that, which is that, you can basically come out and say, everything's awesome, no matter what, we're going to have growth. And they come around 9 days later and say, oh, yeah, never mind. Things are actually pretty terrible and they're going to be terrible for some time. I think that's just a great example of how Europe is right now, how the economy in Europe is going to continue to operate, and why we, for the most part, are avoiding European stocks at this point.
Good deal. Thanks, Tom. Ben, we did get earnings from both Micron and Lulu. Micron up about 2.5%. Lulu up more than 6% pre-market trading. What did we hear from those guys? And as we start to kind of gear up for earnings season in earnest, any read-throughs you could take from those two companies?
Big thing for Micron is that they basically reiterated where they were 3 months ago, which I think is what we're going to see from a lot of companies. I think that already we're starting to get we do a survey every quarter of local business owners, and they're basically saying they don't really have much to update. They're just kind of keeping their heads down. They're aware of all the news, and that's certainly creating some volatility. But in terms of their actual business, they're not really seeing a huge change. And that's the same for Micron. They saw a really good strength in the data center. That was up over 60% on a year-over-year basis. They saw a really good demand from industrial uses for factory automation, security, that sort of thing. And they did say that component shortages are improving, that further improvements should support demand growth for the rest of the year. So this is all good news. They also did caution that some companies are due to supply chain issues, due to Russia, Ukraine, they might be buying a little bit more inventory than they would normally have. These are end consumers, end customers. So I would be watching that. But for now, I think the demand is quite strong, and this is real demand too. I mean, we're replenishing inventories, and we're still pretty light in the channel. So net, I think that Micron was quite good. In terms of Lululemon, they had some really bad Omicron effects. You might remember we were talking about this in January. There's some impacts from there. Employees couldn't come to work. They had issues getting inventory in the door. So they guided down back in January. So the quarter was kind of a wash, but their guidance was very strong. They said that after Omicron began to fade, in the middle of January, they began to see store traffic improve. And importantly, this trend has continued into the first quarter. And they note explicitly in the conference call that, quote, this acceleration underpins our guidance, and I'm excited about the energy I'm seeing in our stores. This is good commentary. This is good qualitative commentary that analysts will latch onto, especially given the sentiment around Lululemon, which was people were scared they would disappoint again. Whenever a company guides down before earnings, you're always a little bit hesitant about where that earnings report will come in. Bottom line, I actually think the expectations for Lululemon were a little bit low. They came out and said that there was an acceleration. It just makes sense that the stock's going to go up and have a good day. How much further it goes is a big question mark. But in terms of the underlying consumer demand, it certainly seems to be there for Lululemon, which is also a good sign for the U.S. economy.
Awesome. Thanks, Ben. Thanks, Tom. We'll wrap it up there. We'll be back tomorrow morning at 8:30.